Employment report out tomorrow. Will that move the markets? This is what you need to know before the bell. Tomorrow morning, of course, is the May employment report. Now, that employment report has beat estimates by a very wide margin over the last 13 consecutive months. Now, that is not only a record, it is a record by a far extreme of previous streaks where employment was outperforming expectations. This has been one of the anomalies over the last couple of years, is how employment remains so strong despite the Fed hiking rates, trying to slow the economy. And we're seeing the economy slow down in the manufacturing side of the economy. Not yet so much in the services sector, but of course, since services make up 80% of the economy and most of the employment results in the lower wage paying jobs of leisure, healthcare, restaurants, etc., not surprising that we see the employment number holding up better here. The JOLTS job opening labor turnover survey came in stronger than expected yesterday as well. That suggests that employment will be stronger than estimates tomorrow. We'll see, but this is a conundrum for the Fed, right? The Fed wants to slow employment in order to bring down inflation. Sticky inflation, that core inflation rate, remains stronger than what the Fed wants at this point. It's not on a trajectory to get down to that 2% level they're looking for, which now suggests the Fed is going to have to hike rates more. June the 14th is the next Fed meeting. Will they hike rates more? Well, that's what we don't know yet, but hints are now rising, and especially from the Fed Fund futures market, that the Fed will have to hike rates more over the course of the next couple of months. That's not really what the market has been pricing in by any stretch of the imagination. We currently have this big chase in technology stocks, which are interest rate sensitive, by the way. And so the longer that interest rates stay higher, the more that impacts revenue for these companies. Markets are ignoring that right now. The question, of course, is will the market come to the realization at some point that the Fed is going to have to hike rates more? Inflation is remaining stickier than expected. That's going to be the big question. Of course, recession. That's the other big thing sitting out there so far. While there's been lots of anecdotal evidence of a recession coming, it hasn't gotten here yet. And of course, strong employment delaying that impact as well. So there's certainly risk to the markets here as we look out further into this year and early next year. But right now, on a short-term basis, markets are overbought. They are on a buy signal right now, so a bit of a pullback or consolidation as we've seen previously won't be surprising. This 4,200 level continues to be resistance right now. The market hasn't been able to firmly break above and hold that just yet. So over the course of the next couple of days, we'll see what happens. But keep a watch on the employment report tomorrow. That's going to give us some real good hints about what the Fed's going to do next on June the 14th. I'm your host, Lance Roberts, and that's what you need to know before the bell.